Afternoon, ladies and gents. It's Cecil here from Your Options Forecast. This is part 3 of our series on synthetic options. You will recall from the first two sessions, when you're interested in setting up an options position, there are two ways to go about it. The direct approach, say, for example, let's say you want to have a long put. The direct approach, just buy the put option, and that's it. The indirect approach, say you buy the opposite option, and then you combine that with a futures, and that combination will give you a synthetic option. For example, a long call combined with a short futures, the combination will give you a synthetic long put option. Okay, it's really important that you notice the following thing. A long call, short futures gives you a long put. Long put, long the futures, again, I'm back into the long call. In other words, starting out of a long call, if I go long call, short futures, long futures, short futures, long futures. I go from long call to long put, back into a long call, back into a long put, back into a long call. I'm switching the direction that I'm trading the market from a bullish to bearish, to bullish to bearish, back to bullish. Okay, so it's really important. So the same applies if you're using short options. Short call, long futures will give a short put, short the futures again, back into a short call. So short call, long futures, short futures, long futures will say short call, short put, back into a short call, back into a short put. Okay, let's try and illustrate that for you. Here is the corn market. Let's analyze corn. Let's use an at-the-money option. Analyze that option. Okay, so let's start off by buying this option. We long the option. I've got a long call, making money above the break-even line. Okay, I now short the futures. So let's go futures, short futures. I've got a long put, making money below. Long the futures, I'm back into a long call. Short the futures, I'm back into a long put. Call, put, call, put. By simply entering and exiting the futures, I'm switching my direction from a long call to a long put, back to a long call. Exactly the same will apply on short futures. So it's clear this. Let's start with a short call. So that's our, that's a futures, clear that, options. There's our short call option. Now we go into the futures, long futures, we into a short put. Short futures, we back into the short call, back into the short put. Short call, short put. So the futures position that we trade in and out of the futures swaps our option position from long the call to long the put. So we're changing direction in the market as the market is changing direction, and this is of crucial importance. Let's say that let me go to a market that shows that characteristic. Yes, Australian dollar is a nice example. Okay, so let's say that I'm using short options. So I started off in this market with a short call option. So I'm above the market with a short call. As the market trades down, I'm making money on my short call. Here I have a 1, 2, 3. As the market turns around, I notice the turnaround in the market. I enter the futures. My position swaps from a short call into a short put. Now I'm making money as the market goes up. Here the market turns around. 1, 2, 3. Okay, it turns around. I swap into a short call again. So now short call. I'm making money as the market goes down. 1, 2, 3. The market has turned around. I swap to a short put. I'm making money as the market goes up. So I never exited this market. I started right here at the beginning with a position, an options trade in this market, and as the market adjusted and changed direction, accordingly I change direction in my option position. So I simply entering and exiting the futures, I swap direction with the market. So my option just went from a short call to a short put, back into a short call, back into a short put, back into a short call. And I ride this market all the way right to the end, letting the market dictate to me when it changes direction, and the moment it changes direction, I change direction with it. And I can only achieve that using a synthetic option. So it's really important, the technique of staying in the market and just changing direction in your market with your options trade as the market changes direction. And that's one of the main ways in which we use synthetic options. There's something that's quite important though. Let me just go back to my grains. Let's go back into this corn market. If you start off with an out the money option, remember I in the previous example I started with an at the money option. So let's move a little bit out. Let's go to a strike 420 option. Let's call 420. Analyze that. This option has got a delta of 0.22, 0.22. So it's a low risk option, far out of the money, and we start off with that option. So let's long that option. That's the futures. Clear all options. It's long the option. Okay, so there's the option. It's a risk of less than 200. Let's put the risk line of 150 in here. Okay, so you can see it's a really low risk trade. It's a delta of only 0.22. If I now swap this option using a futures, by shorting the futures, I end up with a trade that's got a much higher risk. Look at how close my risk line is. So from this position, where I was really low risk, I end up in that position that's got a much higher risk. So just note that. I'll show you the mathematics that went wrong here. So you started off with a call option of a delta of 0.22. You then added a short futures, which got a delta of -1, and the net result of that was a delta of minus 0.78. Okay, you ended up with a delta. So you started off with a delta of 0.22 on your call option. You ended with a put option with a delta of 0.78. Said differently, the moment that you swap direction, your 420 call, which was out of the money, became a 420 put, which is deep in the money. So just take note of that fact, that the moment that you swap direction in your market, take care, look at what your delta looks like, and take note that your risk in your trade may not be the same afterwards as the original risk that you took. It can be used to your advantage. So if you started off a call option, if you started off with at the money call option, and that call option went into the money, then that delta has increased. The moment that you swap direction, you've got a much lower delta, much lower risk trade, and you should be a happy trader. So take note of delta as you swap your option around. Okay. Okay, why is this synthetic thing so important? It's really, remember that, let me show you an example. Let me go back to my currencies and let's go to Australian dollar. That's Australian dollar, and analyze that market. Okay, so the Australian dollar looked like it's going down. So let's search for a strategy that will give us a nice unlimited profit if it goes down. I'm looking through my strategies. Let's go to advanced strategies. Here's a nice strategy. The put ratio back spread, maybe it's brother. The bull put ladder. That's quite a nice strategy. It gives me limited loss if the market goes up, unlimited profit if the market goes down. So let's take that strategy and implement it on this market. Okay, this is a resulting trade. You can see if the market goes up, we cannot lose really more than about $50. If the market goes down, we've got unlimited profit potential here. It's a really nice trade, looks like that. Okay, it's a complex trade, however. So if you look at the total combination, you short the put at a strike of 69, then you long two puts. You long a put at long a put option at 68.5, and you long a put option at a strike 68. Okay, so that situation, that entire trade can be set up as a combination of call options. So you don't have to set it up with specifically a short put and two long puts. Any of these individual positions you can change into synthetic positions. So you can short the put and then use a call option to set up a synthetic long put and a synthetic long put for that one as well. You can short, you can use a synthetic short put for this one and use long puts for this one, or the entire position can be set up using call options. So just look at that. It's a put 69, 68, 68. Okay, let's quickly set that up. Let us save this to show you. Let's save that. Let's clear the position. Now use call options. So it's a 69 call, strike 69 call. Analyze that. That's the one that we short. That is futures. Clear options short. Okay, that's a short option. We reset this. We go to the 68.5 call. We long that one. Reset this. Go to the 68 strike call. Analyze. Long that option. Okay, so here we've got the exact opposite. Instead of using put options, we've now got call options. We need to enter the futures. Remember that the short put, to swap this, we need to short futures. We need the long futures, and to swap the two longs, we need two short futures. So we need one long future and two short futures. That gives us one short future net. So let's go to the futures and short the futures. And they are exactly the same trade position that we initially wanted. Look at the risk side, it's exactly the same trade. However, the implementation, we used a combination of call options and the future to give us that position. So instead of using the put options, we use a combination of calls and the future, and we have the exact same position. Let's just see what happens if I swap in and out of the futures. So I've got the short futures. So long futures, I've got unlimited profit potential as the market goes up. Short futures, unlimited profit potential as the market goes down. So by now swapping in and out of the futures, I swap between unlimited profit on the one side to unlimited profit on the other side. Look at that. Unlimited that side, unlimited that side. Okay. And this added advantage I got because I used synthetic options instead of original strategy. Why is this important? Remember when you go to our website, youroptionsforecast.com, in our newsletter we bring our trade ideas every month, a number of trade ideas every month on the commodities markets. And once you have become a member of our newsletter and you receive these trade options, you need to be aware of the fact that you can implement any of these trades using synthetic options. So it's not always possible when we implement these things live on Telegram. It's not always possible to give you an update exactly the argument behind what we are doing. So the trade strategy might have said, listen, we are buying this put option. When we actually implement it, you might find that we're actually buying a call option, and you might say, but why? What the heck are these guys doing? They say buying a put, but now they go buy a call option. And the whole reason behind that is you might at any time decide, the market condition looks like this, so let's rather use a synthetic put option, use a synthetic put to enter the market. You need to be aware of that, and in your own trading, when you see a strategy, you need to evaluate, is it better to use a synthetic entry or to use the actual original entry? And you can at any time take any of the positions, individual positions in a trade, and swap it out to a synthetic option and use that instead. Okay, guys, sign up to the newsletter, become a free member, some trade ideas. If you become a live member, you can get live trades posted before the market opens. Thank you for watching. Nice day.